So this week we've seen a material rise in the probability of a rate rise because of the Bank of England talking to the market. So from an 18% chance, it's gone up to 54% of a quarter point rise in November. That's meant that gilt pricing has moved, so we've seen a 25 basis point rise in the gilt yield, the 10-year gilt yield. And that in terms of the price has sent the 10-year gilt down 2.5%. So that's around 3 years of income that you've lost in a week. The impact on currencies has been equally strong. So year to date, we've now seen sterling rise 10% against the US dollar, obviously because of this renewed confidence in rates going up, because of inflation coming through in the UK, but also because of the issues with the Trump Organization and issues with Korea. Against the euro, it's been much less strong. So we're still down 3% against the euro year to date. But in terms of where we are longer term, in terms of sterling dollar, what we've seen here is post-Brexit we had that emergency rate cut, and that took the pound down to 135 against the dollar. We basically put that rate cut back in, that 25 basis point cut back in, so we're back to 135 against the dollar. What we're seeing also this week is we've seen the first piece of core inflation data from the US in 5 months that's beaten expectations. And that is symptomatic of what we're seeing across the developed markets in the UK, Europe and America in terms of tightening conditions simultaneously. Now that has an impact on equity markets and is a threat to the bull market because relative value will worsen as bond yields go up. In terms of the dividend yield that the equity market can produce. Margins will be compressed by higher interest rates and higher wage rates, and the present value of future cash flows will diminish because the discounting number is higher. As you can see here, we've talked about this before, but the bull market of the S&P back since March 2009 can be categorized in 2 phases. So between 2009 and 11, the EPS of the market in the States rose 67%, and the P re-rated by about 18%. So you got an overall return for the S&P of about 100%. Between 2011 and 2017, EPS rose 32%, so less rapid in terms of the earnings trajectory, but the PE of the market re-rated 76%, so the overall return was around 111% for the S&P. In 2017, and likely in outer years, EPS growth is probably in the States going to be slightly more moderate, and PE re-rating is going to be difficult if we are seeing interest rates go up. So it's a real advert for being active rather than passive in terms of your management. So in terms of the investment strategies on a regional basis, you know, the UK remains politically uncertain. We think obviously we've had this bake back in of the quarter point rise, but we're still going into the Brexit negotiations, and we've still got sort of potential operational deterioration there. Domestic Europe for us has become an improving picture and an attractive place to invest. So we've got the ECB policy cycle and the domestic earnings recovery coming through at the moment. So reallocation of some of that US or UK exposure over to Europe this year has been a good strategy. And still using the US for growth because of those unique growth platforms that are listed in the US, and some policy optionality where we're seeing some value sectors that could react very well if, for example, we got that tax legislation through Congress. In terms of at the stock level, there are 4 sort of guiding principles for portfolios at the moment. Firstly, protection against the reflation trade and the effect that higher rates will have on margins. Secondly, looking for higher sales growth through those structural change stocks and ideas. Thirdly, looking for high free cash flow and low duration, so less sensitivity to rates rising. That's typically the value sector. And fourthly, the ability for companies to accelerate their cash returns to shareholders. So lots of the market we've had steady increases in dividends over the last 5 or 6 years as earnings have stayed static, but payout ratios have grown. So we're looking for areas of the market that haven't grown their payout ratio, which can actually do that even if earnings are slightly static. So for more information about those areas and places of interest to invest and protect yourself against rising interest rates, please speak to your investment manager. Just looking at the week ahead, it's a quiet week. The key interest will be Ocado on Tuesday. Thanks very much.